We've been talking about ETFs and index funds from the previous two webinars. The idea was that you invest in ETFs to hedge against risk, and mostly you do that through diversification, which is if you want to be stable in the market, you choose to invest in a lot of stocks. But what is the best way to do that? ETFs is one of those best ways to do that, because ETFs is a collection of different stocks depending on whatever criteria that is appealing to you. So when you do that, you are essentially buying a larger section of the market, thereby diversifying your portfolio through just one or two or three ETFs, and that way you tend to hedge against risk and avoid all those other mishaps that can happen when you invest in one or two stocks that really do good for the meantime, and then one day, they just drop out of nowhere. We've seen this with the likes of Facebook, Microsoft, Amazon. These big companies that you think, wouldn't drop 20, 30%, actually ended up dropping 20 to 30% and even more. Companies like PayPal dropped really down. So hedging against such kind of risks is something that you can do when you invest in index funds and ETFs. And the other idea of investing in ETFs is you're investing in ETFs for the long term. So any short-term drops and issues that happen in the market don't really affect your position that much, because let's say Facebook, Microsoft, and Amazon drops, but an ETF that has 100, 150, 200, 300, 500 companies, if 10 drop, you still have like 490 to keep your portfolio afloat. So investing in ETFs is a little bit advantageous in that sense that you're not looking forward to big losses all of a sudden. You're looking to invest slowly over time without worries of checking how is your account doing, which one should you buy today, which one should you sell. It's mostly hands-off. All you'll be doing is regular investments, deposits here and there, just investing over time, slowly by slowly. So this is good for those who are just getting started with investing, because all you need to know is I'm buying this ETF and this is the only one I'm buying, and therefore you don't need to do a lot of research. If you're not familiar with how to do research, you don't need to do a lot of risk management, a lot of rebalancing, among other things. What you'll be doing for the most part is just you deposit your money, you go and buy that ETF. You deposit the money, if it's every month, you deposit the money and you go buy that ETF. So that brings us to this idea of a three-fund portfolio. Now, by fund, I mean, we know an index. To invest in an index, you invest in something called an index fund, which is, yes, an index is a list, and then now the index fund is what you invest in, which is a reflection of that list. With an ETF in full is exchange traded fund. So right there you see that the name fund is in both index fund and ETF with the exchange traded fund. So by three-fund portfolio, it means you are either having one index fund and two ETFs, or two ETFs and one index fund, or three ETFs or three index funds, a combination of either one of those. That your portfolio is mostly consisting of ETFs or index funds, or a combination of both. And that's where the term three-fund portfolio comes in. Now, what's the advantage of a three-fund portfolio? The advantage is you don't have to worry about how the market is doing, what's going on, which ETF do you buy, which one do you sell. This is mostly you're investing for long term, and you're going to pick the top performing ETFs, top 3 performing ETFs, or top 3 performing index funds, or top 3 ETFs, or in combination with index funds, and you just put that in your portfolio. And what you do is you hold those ETFs or index funds, knowing that these are the best performing ETFs or index funds, and if I hold them over time, I'll make good returns. Now, a lot of hedge funds, a lot of money market funds, a lot of investment firms, they really struggle with performance. Yes, they might do well in the short term, but in the long term, they usually end up underperforming such benchmarks as the S&P 500, the Nasdaq, or the Russell Index. So, which tells you that yes, you can do day trading, you can do swing trading, short-term trading, and investing, but at the end of the day, that gives you short-term gains. But if you're looking for long-term gains that will outperform the market for the most part, try and get some of these ETFs in your portfolio, or set up a 3-fund portfolio, which means you are picking the best performing ETFs and you're riding them throughout time. So with that, we get to understand why you need to invest in a 3-fund portfolio, because a 3-fund portfolio will essentially outperform most active investors over time. By active, I mean day traders and swing traders and scalpers and all that. A 3-fund portfolio will do that. And this gives you an idea of, if you're trying to invest for retirement, if you're trying to invest for future income, if you're trying to invest for dividends over a long period of time, doing a 3-fund portfolio gives you better results than if you were to go and just pick specific stocks and ETFs for short term. So this is a good investment choice or investment strategy, and with this you have better chance of surviving stuff like inflation, huge market downtowns. You essentially will be almost, I would say, inflation and recession proof, because in an ETF, not all the stocks will go down in a recession, not all the stocks will go up when the market is doing good, but on average you'll be outperforming a lot of investors. So this is why you do a 3-fund portfolio. Now, it has its advantages and disadvantages, but among them, the advantages, the last one is, when you're investing, the number one issue with a lot of investors is capital. People don't have enough capital to invest. Now, if you don't have enough capital to invest, why would you want to buy 10, 20, 30 stocks when you're buying maybe 1 or 2 or 3 stocks at a time in each one of them? That's really counterintuitive, in the sense that, yes, you can buy one stock that goes up 10%. If the price of that stock is $10, it goes up 10%, that's $1. And you've only bought 2 or 3 shares of that stock. So you're only making $3 in that. But now you spread your capital across 10, 20 different stocks, and in each of those you're making $2, $3, $4. It's really counterintuitive, in the sense that if you had put your money in 1 or 2 or 3 stocks, you'd have done a little bit better, because if you invest, say, $500 in a stock that is $10, and that stock goes up 10%, that's $50 in that one stock, which for sure is going to go up. But if you spread your capital across too many different stocks and ETFs, what if some of them don't make profit? Now you have $50 here, $100 there, that is on the negative, and then you're making $10, $20 here and there, at the end of the day, it won't give you a better outcome. It won't give you a good projection of performance over time. So investing in a 3-fund portfolio will give you a better outcome, in the sense that you are putting your scarce resource, which is capital, in just 3 funds or ETFs, and thereby maximizing the potential of these ETFs. Like I said, investing is a very expensive venture or affair, and if you have limited capital, you wouldn't want to spread that capital across too many investments. So, given that situation, with limited capital, you want to invest in as little number of ETFs or index funds as possible, or stocks. So in that sense, you get to have an advantage, in the sense that yes, you have limited capital, but you're maximizing the potential and performance of this capital. So with that, I'll say this, that the disadvantages is, yes, you're stuck with 2, 3 ETFs, maybe 4, 5 for a long time. It's going to be boring. It's going to be, you might not do a lot. You might think nothing is happening. But over time, you realize there's a lot that is happening. So I'll try and show you guys something if you're on video. I'll look at, say, the Vanguard Total Stock Market ETF, and we can see how this ETF has performed over time. Let me just bring this to the screen here, okay, and show you that an ETF will really do good over time, but in the short time, it moves a little bit slowly. You'll be like, I'm just wasting time here on this ETF. Nothing's really happening. What's going on? But if you look at time, that's where the time aspect comes in. Over time, how are you doing over time? What is the growth? What is the performance over time? That's the thing that makes a big difference when it comes to investing long term, because in the short term it looks like you're doing nothing, but in the long term you'll see that there's a lot that is happening. So this is Vanguard Total Stock Market ETF, which is they invest in all the stocks in the US stock market. So from that term, total stock market, so it's generally almost all the stocks that are in the stock market. And as you can see, back in 2002, the growth was steady, and then drop over 2008, and then growth again happened, and then there was a drop in 2020, then another growth happened until end of 2021 when it dropped again. So if you just take a chunk of this ETF and look at, say, 2016 to 2018, you realize that in that 2 years, didn't really do much. Okay, like 53% in 2 years. But if you had invested, say, from 2010, let's say 2012 to today, to make that 10 years, so from 2012 right here up to today, that would be 234%, which on average, I know that's not this is not the geometric mean. This is the geometric mean, but not the arithmetic mean. There's a difference there. But on average, it's around 23% for 10 years, it's 2.3% a year. But if you do, if you do the other way around, yearly performance is going to be way more than 12% a year. So that's the reason as to why you invest in such ETFs. And whenever there's a drop, somewhere like in 2016, there's a drop there, you buy a little bit more. In 2018, you buy a little more. In 2020, you buy a little more. And guess what? Right now, it has really dropped significantly. And this is the part where you buy a little bit more than normal. Your normal either monthly schedule or whatever. So this has dropped 20% since the beginning of 2022. If you're buying now, you'll be in for a good growth when it recovers and goes back up to the beginning point. So as you can see, if it were to go back, yes, it has lost 20% right now, but if it goes back up to where it came from, that is break even, you're doing 26%. So there's already a 6% difference there in growth. Now, that's just a Vanguard Total ETF. This was just an example to show you that over time, ETFs do perform way better than if you had to invest in single stocks. And drops like the drop of 2020 to 2008 really didn't do much. There's this S&P 500 by SPDR. This is the S&P 500 ETF. And with this, you can see that it's also been doing good all this time since, the drop of 2008. Been going up really nicely. There's a drop right now, and this is a good point to buy. And one thing I forgot to mention about the Vanguard ETF, the same way with the S&P 500, is whenever there's a drop, there's usually a higher recovery. So the drop of 2008 for S&P 500 ETF was at from 156 to around 70. But the recovery went all the way past that 156. It went to 200 before it stagnated a little bit. There was a little bit of a drop back in 2016, but then it recovered, went even higher, dropped a little bit in 2018, recovered, went even higher, dropped massively in 2020, went even higher than that. So whenever there's a drop, you're guaranteed, or not really guaranteed, but there's a higher chance of the recovery being higher than the previous high. So the previous high right here on this S&P 500 ETF is at around 480. We expect that when it recovers, it's going to go at least 480, maybe 560, or even higher than that in the next couple of years or so. So if you're investing right now and it goes to that 560, you're doing 35% in 2 years cumulatively. Then, which means you'll be doing a little bit better than if you just, invested in single stocks and ETFs short term, where you might end up losing or you might end up missing a few things here and there. Because out of the thousands upon thousands of stocks, chances are you'll not get all of them. But an ETF kind of gives you that privilege of putting a lot of stocks in together and investing in them at once. So how do we create a 3-fund portfolio? A 3-fund portfolio is as simple as finding 3 ETFs that you like, and from the poster you can see I've put a few ETF issuers there. We have the Vanguard, we have Invesco, and we have Fidelity. That thing disappeared. Yeah, we have Fidelity, we have Charles Schwab. So these are among the top issuers of ETFs. There's iShares too, but it's in the previous poster, it's not here. So Vanguard, Invesco, Charles Schwab, Fidelity. These are some of the best issuers. And when you're looking for a three-fund portfolio, what it means is you can either go to Vanguard and pick the top 3 performing Vanguard ETFs and put that in your portfolio, or you can go to Invesco and pick the top performing 3 ETFs from Invesco and put that in your portfolio. Same to Charles Schwab and same to Fidelity and the other issuers. So when creating a three-fund portfolio, one, you can create it based on the issuer, which is, if you know Vanguard is a good performing ETF issuer, you go and get Vanguard ETFs. If you know from your research or from recommendation, you know Charles Schwab has the best cost for the ETFs or index funds. That is, they have the cheapest price. Then you go get that. If you know Fidelity has they have zero cost index funds, so that's a good attraction to go for Fidelity over, say, Charles Schwab, which charge you like 0.1 something percent, 0.01% or whatever per ETF, per index fund. So when choosing, you either choose based on performance, choose based on issuer, or choose based on incentives given by the issuer. Say, like Fidelity, which has zero cost index funds, you might want to go for that, which means it will cost you nothing to invest in that in their ETFs and index funds. The other way of creating a three-fund portfolio is you say, okay, I know the Vanguard Total ETF does better than iShares Total ETF, so I'll go with Vanguard. But the Charles Schwab Bond ETF does better than the Fidelity Bond ETF, so I'll take Charles Schwab Bond ETF. And then the Invesco Retail Market Sector or Consumer Market Stocks ETF does better than Vanguard, so I'll go with Invesco. Now you have Vanguard Total Market ETF, Invesco Consumer Staples, and Charles Schwab Bond ETF combined. So you have 3 of them. One is a bond ETF, one is a consumer staple ETF, and the other one is a total market ETF. And now that makes 3 of them, each from different issuers. So that's another way of creating a three-fund portfolio. And the last is based on your objectives. That is, why are you investing in these ETFs? Are you investing in them for long-term growth, or are you investing in them for preservation of capital, which is hedging against inflation, among other things? Or are you investing in them based on because of dividend and income reasons? If whichever one of those reasons is your reasons, then you go looking for ETFs that do that. You go for, say, Fidelity high dividend ETF for dividend investing. You go for, say, Vanguard Bond ETF if you're trying to invest invest and hedge against inflation. You can invest in Charles Schwab municipal bonds, municipal and corporate bonds, for whatever reasons that you're trying to invest. So that's also another way of picking and choosing which ETFs to invest in. And in that sense, you realize that over time, your reason will determine which ETFs you're putting in your three-fund portfolio. And then over time, if one of those ETFs underperforms, you switch it up with another one. Say, this time round, you go with Charles Schwab Bond ETF, but then 2 years down the line, they're not doing so well, but Vanguard Bond ETF is doing good. You switch it up with the Vanguard. Now you're just switching between bond ETFs. And then if you're looking for high dividend ETFs, say the Fidelity high dividend ETF is not really doing that good in the next 2-3 years, but Invesco just came up with something that does a little bit better than that, then you switch it up with that. So that's what you do when you're trying to now what we call rebalancing your portfolio after creating it in the first place. So over time, when things start changing, you also need to change. It's not like once you've invested in these ETFs, it's permanent. No, you can switch it up a little bit here and there just to see to it that you get the maximum performance over time. So that's part of creating that ETF, the 3-fund portfolio. And one other thing is, when you're creating, say, a growth-oriented portfolio, you might want to invest in around 3 of them, 3-fund. Create a 3-fund for long-term growth. But if you're creating something like a dividend portfolio, you realize that you might end up creating maybe a portfolio of 5 to 10 funds. That doesn't make a difference in terms of it has to be 3. No, like 3 is the best. The minimum you can do is 3. The best you can do is 3. But in certain situations, based on your investment goals, you might want to switch it up a little bit, add 2 or 3 more, maybe 4 more to make it 6 or 7 or 5. So like you're investing in dividends, you might want a little bit more of that, but also realize that if you have more of them, then you need to invest more. So if you're investing for dividend, you have a threshold to meet per ETF to get your desired return. Let's look here at the Fidelity high dividend. What is that? Fidelity high dividend ETF, FDVP. And what I want to see here is the dividends. So as you can see here, let me maximize this to be a little bigger. Over here, where the cursor is, shows you that the Fidelity high dividend ETFs pays around 2.87% dividend. It has a 2.87 dividend yield. And what that means is the price right now it's at $40. So if you're getting a dividend of 2.87, it's 2.87% of the current price, which is that $40. So that's $40 times 0.287. That means per every share of Fidelity high dividend ETF, you're getting $1.14. Now, if your goal is to make $200 per, let's say, quarter, if they're doing it quarterly, if your goal is to make $200, so that means you'll have to buy around 175 shares of the Fidelity high dividend ETF. Now, 175 shares, that multiplied by the current price, that means you're spending around $6,000, $6,900 in that one ETF. Now, if you're buying 5 of them, that means your total capital investment will have to be around $30,000, $35,000. So at the end of the day, you have to also figure out, okay, how much money do I have and what is the best outcome I can get? Yes, I'm trying to invest in dividends. I know I might invest in, 3-4 extra dividend ETFs, but can I achieve my goal with 3 ETFs and based on the capital that I have at the moment? So Yes, you can start with $500, $1,000, $3,000, but your goal should be, say, I want to end up earning, say, $200 in dividends by the end of the year. That means, if you're starting with $1,000, you need to invest around $6,000 by the end of the year to achieve that goal, and that is in one ETF. Now, if you are trying to do that in 3, 4, 5 ETFs, you need to also do that calculation and realize, okay, if Fidelity is giving me 2.87, let me see how much, Vanguard High Dividend ETF, it's right there. And this one is also doing 2.8. The other one was 2 point something. The other one was 2.87. This is 2.8. So as you can see, you have to really look and find the best combination of, say, dividend ETFs to achieve your outcomes. And therefore, you can say, okay, I'll get this ETF here that will give me this much in dividends. And then if I have 10 shares here of this and 50 shares here of that and these shares here of that, it will earn me my expected dividend income of, say, $200 a month. So based on your capital, based on the expected income in terms of dividends or growth or whatever, you can figure out what do you need to achieve your goal and how much do you need to spend for how long. So the time frame is also key to this. How much are you going to invest in that time frame, and what is your expectations? So that's one way of just looking at this in terms of why you're investing, for how long, and how much will you need, and that's a way of figuring it out. So in my spare time, I went ahead and created sample 3-fund portfolios that I think would be a good example to show that over time these portfolios are better performing than just buying single stocks and trading them on a regular basis. So right here is my sample. This is a Vanguard 3-fund portfolio. And in this Vanguard 3-fund portfolio, I have the Vanguard Consumer Staples ETF, that's a VDC. I have the Vanguard S&P 500 ETF, VOO, and I have the Vanguard Total Stock Market ETF, VTI. Now, from this sample portfolio, I made the transactions June 1st of 2012. Based on our previous webinar, when we were having it, was June 1st, 2022. So that will make it a 10-year period. So as you can see, amount spent on each of these ETFs, the first one is around 1,600, the second one is 1,900, and the third one is 1,300. So in total, it's 1,660, 1,972, and 1,344. You would have invested around $5,000, which is 500K. So back in 2012, if you had invested 500K in this 3-fund portfolio, right now your portfolio will be worth $14,000, which is around 1.5 Kenya shillings, 1.5 million Kenya shillings. So 500K back in 2012, 1.5 million in 10 years growth, which is a good long-term investment. And as you can see, you're investing only 500K, so it's not really that much expensive to invest in this kind of portfolios to get that kind of outcome. So as you can see, some of these ETFs really did good in that 10-year period. The VDC, which costed us 1,600, is now worth 3,800. So that's more than more than double, right? The VOO S&P 500 costed us 1,900. The value right now is 6,500. So that's almost 3 times growth. I think that's the outcome. Over three times growth over time. And then the other one was 1,300, and now it's 4,300. So that's a $3,000 growth. In terms of percentages, you can see it has done 130% in the last 10 years, 229% the last 10 years, and the other one has done 225% in the last 10 years. And this is including the 2022 drop, because if you factor in the height of these ETFs back in end of 2021, chances are you would have made even way more in terms of performance, because right now some of them have dropped 20-30%. So if you were to look at the best performance or best time frame to look at end of 2021, you would have really done well investing in this ETFs, in this 3-fund portfolio. So this is just one of them, sample 3-fund portfolio. There's another one right here, and this is the Vanguard. Also, it's a Vanguard 3-fund portfolio, but this time round I included, say, one bond index fund, which is the bond index fund from Vanguard BND, and the S&P 500, and then the total stock market ETF, the VTI. Just like the other one, you can see it's almost similar performance, really good growth. Total return in that time frame at 48%. I think the bond ETF wasn't really doing good for the most part. It was dragging it down. In terms of dividend, it doesn't really have a lot of dividend in this 3-year period, 3 months performance though. But if we were to, this is investing in terms of for growth purposes, not for this is not for dividend. So the dividend yield right here, you can see is 1.5%. The target when you're creating a 3-fund portfolio, you need to achieve at least 3.5% and above to be able to earn a good dividend income out of it. So in essence, this is a sample Vanguard ETF, 3-fund ETF or 3-fund portfolio, and it has a lot of things going on here. You have a 21% capital return, dividend received in that time frame, and all that. You can see, you can, like, what I'm trying to say is you can also do a simulated portfolio like this one for whatever ETFs you're choosing. So if you're trying to pick 3 ETFs or 4 ETFs, you can make a sample portfolio, calculate, extrapolate that information back in time, 5, 10, 20 years, and see if you had bought this if you had invested in this ETF that you're making, in this portfolio that you're making, how much would you have earned in terms of returns over time? So that's another way of trying to see what's the performance of your 3-fund portfolio before you invest in it. So yes, you can find one ETF that is good, but maybe over time it doesn't really do that much. Maybe the performance is short term. It's been doing that for the last 1 year only, but before that it wasn't that good. So trying to figure out how it's going to perform, you can use a sample portfolio like this one. I have another portfolio of dividend, and with this one you can realize now that I have a lot of dividend ETFs and also stocks. So Reason is, with dividend investing, you might need a little bit more, but getting to that 10 ETFs, index funds, and stocks is usually the benchmark. As in, you don't want to exceed over 10 of them. So 10 and below. And as you can see here, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 combination of 10 ETF, index funds, and stocks. Now, with this portfolio, you can see here is what among the top performing dividend portfolio, ETFs and stocks. And you can see here, this one is doing 9.9% dividend. This one is doing 10.32. My favorite right here, which is a PSP, is doing 12.97%. There's this also, AGNC is a rate, real estate investment trust that pays out dividends, and it really pays good dividends of around 12%. There's another rate, ARMA Residential ARR, that is doing around 16%. There's an ETF here, DMRE, that is doing around 19% in dividend yield, and so on and so forth. Now, when you're looking at dividend portfolios, you also need to look at dividend growth. Is their dividend growth constant, negative, positive, or whatever? So you can see here the growth here is at 3% for the first one. The next one is 2%. For the PSP, that's why it's my favorite. It has done 45% growth in terms of the dividend growth. So that means they increase their dividends every time, and so far they've increased it by around 45%. And the other ones have dropped 15%, 25%. This one has increased it by 14%, which means if something was giving you $1 per share, and now they have increased it by 14%, that means they're giving you around $1.14 dollars per share in dividends. So that's also something you need to look out for, an ever increasing dividend growth on top of a high dividend yield to be able to earn a good dividend income. Now, in terms of the cost, you can see most of them are between 1,000 and 2,500. Now you can see here that with the PSP, which is the best performing, I've given it the highest investment. The next one also got the highest, and then the one that followed got a little bit less, and then the least performing is the one that has the least investment. So that's also a way of strategizing how to allocate your capital to these different dividend ETFs and stocks. That the best performing gets the highest amount of capital, while the least performing gets a little bit less of capital. Now, this portfolio is doing around 6.7% in dividend yield. I recommended 3.5 and above. So this is, you're doing almost double of that. So that's a good performance in terms of dividend yield. Investment return, it's doing around 31%. For those who are in SIP accounts and other accounts, I've talked about 20%. With such portfolios, you can see you can do more than 20% if you want a year. You can do more than 40%. It just depends on what combination of stocks and ETFs and index funds you are putting in your portfolio. But if you really do your homework, you realize that there is unlimited performance on how much you can make in terms of returns annually in such kind of portfolios. Like this dividend portfolio is doing 31%, way better than money market funds and other stuff like SACCOs and the likes. Because for them, I think I mentioned this in the original webinar, that some of these money market funds and SACCOs, they're giving you around 12%, 10%, 9%. But on top of that, they're charging you 2 to 5% cost of investing with them. That is the fees and whatever that they charge you is around 2 to 3%. So yeah, they're giving you 12%, but they're taking away 2.5. So you're left with like 9.5, 9.8, 10.2. Why would you go for that when you can create this is a 10 fund portfolio of dividend ETFs that will give you 31%, and the 31% doesn't come with hidden costs and charges and taxes and all this manner of expenses. So this is one way of saying that yes, we have different investment vehicles, but some of them are not advantageous to you, or they don't benefit you as you should benefit from them. So to avoid unnecessary expenses, among other things, you can create a 3-fund portfolio or a 10-fund dividend portfolio like this and earn a little bit more than what you could have earned in a SACCO or a money market fund. So this dividend portfolio is doing around $2,000 in dividends annually. That is 200K. By 2025, it will be doing around $4,000 a year in terms of dividends in income. So say this was your plan. You want to make around 400K a year in your dividend income. This is the kind of portfolio you need to create that will earn you around 400K a year in income passively. So all you do is invest in it and get your money every quarter, depending on whichever ETF and stocks that you've invested in. So 400K translates to something like 33,000 Kenya shillings a month, of which I know is not a lot, but it's a lot compared to zero. You know, if you're not earning any passive income and all of a sudden you start earning 33K, that's a very good income to supplement your day-to-day monthly income. So in total, this portfolio would earn you $10,000, around $11,000 in a around 4-year period. So this is some sort of histogram that shows you what kind of ETFs and stocks you've invested in terms of their performance. They've said here is diversification. How diversified is it in terms of performance? And as you can see, there is here high yield, low growth. There's here high yield, high growth. There's here low yield, low growth. And there's down here low yield, high growth. Now, where you want to be in terms of whatever ETFs and stocks you're buying for your dividend portfolio, you need to be right here on high yield, high growth. 90%, 80%, 70% of your dividend ETFs and portfolio and stocks need to be in this section. If they're not in this section, they should be here, high yield, low growth. So they give you a lot of, in terms of yield, a lot of dividends, but the dividend per year doesn't grow that much. The first section right here on the right, top right, is they give you high amount of yield in terms of dividends and also growth. So year-on-year growth on dividend is also high. It grows every time. Now the places you need to avoid is down here, low yield, low growth. So when you have invested in such an ETF, in such a portfolio, and then all of a sudden one of your ETF or stock drops into this section, that's the one you need to get rid of. You get rid of that because this is doing very low in terms of dividends and is also doing very low in terms of growth year on year on the dividends. So you get rid of that. This one too. But if it's over here, low yield, low growth, that's a no. It has to go. Low yield, high growth, maybe, because you're starting at around 2%, and maybe it can grow maybe to 3, 4, 5%. Maybe here. But low yield, low growth, not to be part of your portfolio. So this is projection. You're starting in 2022 with around $17,000, and then by 2025, you can see here your portfolio would have grown to around $33,000, $34,000, which means in like 4 years, your portfolio can double in terms of growth. And your dividends did around 4 times in terms of growth. So when it comes to dividend portfolio, this is a sample dividend portfolio. Some of these you can invest in them directly or on your investment accounts. You don't need to call anybody. You don't need to go anywhere. Just with your broker, you search for the ticker symbol and you invest in it. So we're going to the next section, which is towards the end, which is when you're looking for these ETFs, where do you look for them? I know I have said these are the issuers: Vanguard, Invesco, Charles Schwab, Fidelity, and the likes. But how do you find some of these, and how do you know what they've invested in and what their plans are? So you can go to their website, like the Vanguard. They have the investor.vanguard.com, and under Vanguard, you go to ETFs on their page. You go to just, instead of mutual funds, you select ETFs, and then here you can see the various bond ETFs that they invest. So like this first list is the US bond ETFs. The second list right here is investment grade ETFs. And the third list here is there's a tax exempt, one tax exempt bond ETF here, but that's another story. There's a US stock ETFs, large cap. Then there's this is where you find the Russell 3000, Russell 1000, S&P 500, large cap, high dividend ETF, high dividend appreciation ETF, among other things. So the large cap is where a lot of stuff is, and the mid cap is the mid performing companies. So the S&P mid 400 ETF and the likes, and then the small cap, which is the Russell 2000, the S&P 600 and the like. So this is where you find some of this stuff. Now, we've looked at the Vanguard Total Market ETF. If you want to know their prospectus, you want to know their performance, you just click on that and it will load up a page that will show you what is the performance of this ETF over time. Potential risk here, it says is moderately high, because in terms of risk, there's low, medium right here, and then high, and then highest is 5. But yeah, you can see the performance. You can see over time, this is from 2012 to 2022. You can see it has grown like that. So if you had invested 10K in 2012 in this ETF, by end of 2021, you'd have around $40,000. So that's 4 times growth in a period of 10 years. So we go to the portfolio composition. This is where you find what have they invested in, by how much. And for the most part, they've invested around a larger portion in technology companies. The next section is the consumer companies, then financials, then healthcare, and then financials, then industrials, then financials, and the list goes on like that. Among the top companies they've invested in is Apple, Microsoft, Google, Amazon, Tesla, Berkshire Hathaway, United Health, Johnson & Johnson, Facebook, and Nvidia. Those are the top 10 companies. And you know this, that Apple is too expensive for one person to buy. Microsoft is too expensive. You know, we're looking at $200, $300 for some of these. Berkshire Hathaway is the most expensive here at around, I think it's $50,000 right now a share. So you as an individual, you cannot buy each of these companies by themselves. So you would benefit more by buying this ETF more than buying the individual companies. And that's the advantage of investing in ETFs and index funds. And you can see the current price of that ETF is only $200. So with $200, you can buy one share, as compared to maybe $200 and something dollars of Microsoft. I know Amazon split their shares the other day. Was it yesterday? They split their shares, and right now it's trading at around 124 after the split. So that's only Amazon. If you go to Facebook, that's another story. You know, if you go to Nvidia, is another story. Too expensive to be bought by one. See, $180, $190 for Facebook. So for you to take advantage of some of these companies, like Facebook, like Amazon, like Microsoft, just go buy an ETF like the Vanguard Total Market ETF, and that will save you a lot of headache in terms of trying to figure out which stock to buy and which one not to buy. So diversity is key here. It will give you that option. Now, that's Vanguard. I've just gone through one ETF. You can go back and look at the other ETFs that you're checking them out, whichever it is. So I forgot to show you I think you can explore more if you have that time. You can explore stuff like the price and performance. You can explore how has it been doing the 52-week period, whatever, all that. You can do the portfolio and management. That shows you what kind of blend this portfolio is. It's large cap. As you can see here, types of stock, earnings, among other things, and all that. All these, the companies they've invested in, the benchmarks they're going with, and the likes. Fees and associated costs will show up here. They on average, expense ratio is 0.03%. Average ratio of similar funds is 0.8. So this is doing really good at 0.03. So you can see here, in terms of fees, if you invested $1,000 with this ETF, it will only cost you $71. And in other similar ETF, it will cost you $1,800 in terms of cost. So those are some of the things you need to look for, among other things and the like. So this distribution is where they show you the dividends per share and history. In 2020, they paid out 78 cents. In 2021, they paid out 67 cents. 2021 again 67, 2021 again 72, and you can see how often they pay out the dividends, when is their ex-dividend dates, and when is it payable. So say for this one, you would have had to buy that, you would have had to own that ETF by March 23rd, and you would get your dividend by 28th. So a five-day period, and you get your money in terms of dividends. But that's just diving deep into what the ETF is all about, which I know I covered in the previous webinars. So if you want to know how to analyze an ETF and see risks and returns and all those other things, you can refer to the previous webinar, and there's a video on YouTube. But let's go forward and look at the other issuers. We have the Fidelity, and Fidelity is also ETF issuer. They have the Fidelity Total Bond ETF, they have the Real Estate ETF, they have High Dividend ETF, Consumer Staples ETF. So this FSTA and the Vanguard VDC are kind of the same. So you can compare these and that and see which one is performing in what way. So with this, you can also go through their list of ETFs and see what they are all about. And if you click one of them, like this one, it will show you their prospectus. It will show you there is a prospectus here, performance over time. You can adjust to look at a longer time frame. As you can see, it's been growing steadily. Price right now it's at $44, which is very affordable. Growth over time, it's like that. Performance, on average, 1 year period is doing 12%. 3 year period is doing 13% a year. 5 year period is doing 9% a year. And the life of the ETF has done 10% plus. Holdings, you can see here the big consumer staples, Procter & Gamble, Coca-Cola, Pepsi, Costco, Walmart, Phillips Morris International, Altria, Colgate, we know Colgate, among other things. So if you want to dig deep into what that ETF is all about, you can refer to the previous video, as I said, where I showed you how you can go to morningstar.com and figure out all that stuff, analyzing an ETF. So just like Vanguard, you can see also with Fidelity, you can go and dig deep into what an ETF is and what all the metrics. So the other issuer is iShares. iShares is managed by BlackRock, and somehow they've partnered with Fidelity, and you can access iShares ETFs via Fidelity. So here is iShares through Fidelity, but then now they also have their own group of ETFs like the S&P 500, emerging markets, the Russell 2000, total stock market ETF. So this ITOT and Vanguard's VTI, they're in the same category. So you can say, can I compare VTI with iShares ITOT and see which one is best performing? So that's how you figure out, okay, do I go with iShares ITOT or do I go with Vanguard VTI? So same goes to how you screen and analyze. It will give you their page and the ask and bid prices, among other things. Like I said, how to analyze, you can refer to the previous video, see the performance, see all these other things. It's doing 18% in 3 years, 15% in 5 years, and 14% in 10 years. So it's really doing good. You can do all that analysis through Morningstar and previous suggestion of websites to analyze ETFs. So you can still go back and look at the other ETFs in the list of ETFs. So many of them, a lot to choose, but depends on what you're looking for. Like you can be looking for corporate bond ETF. They have one. If you go to Fidelity, they also have a corporate bond ETF. If you go to Vanguard, I know they have a corporate bond ETF, and you can pick and see which one performs how, which one is better, which one is not. So the other one is Invesco, and Invesco, just like the other ones, has also a list of ETFs, S&P 500, among other things, real estate, So if you're looking to, say, invest in an Invesco ETF, you might see some of these, like a 1 year performance. This is doing 76%. This one is doing 64% in 1 year. This one is doing 57%. You know, among other things that you can attract you into getting into some of these ETFs. So same with the other ETF issuers. You click on the ETF and it will show you what the ETF is all about, its performance, year on year, risks, prospectors, among other things. So all that risk information, they have their prospectors right there. You know, if you want to see what their holdings are all about, if you want to see, among other things. And the last one is Charles Schwab that I'm going to talk about today in terms of issuers. And so the Charles Schwab ETF trademark, and they have their list of domestic ETFs right there. So the Schwab 1000 Index, US Broad Market, Large Market ETF, Large Cap Growth. They have a Dividend Equity ETF. They have small cap, mid cap, real estate investment trust ETF. You know, they have international ETFs for emerging markets and the likes. And they have fixed income ETFs, stuff to do with corporate bond ETFs, US Treasury bonds ETFs, you know, and the likes. So these are some of the Charles Schwab ETFs, and you can see some of them will cost you $0 to trade them online, so you won't get charged for commissions and the likes as compared to other issuers. So that's Charles Schwab. As you can see, they have something similar to what Vanguard has and what Fidelity has and what the other ones have. So it's up to you to figure out which one is the best and pick 3 or 4 or 5 out of them and make it a portfolio and then invest in it. The last thing I want to talk about is this website is etfdatabase.com or etfdb.com. With this website, you can screen for ETFs. So if you go to this website and click on tools and select ETF screener, this screener will then enable you to choose and pick ETF based on whatever criteria you want. So let's say you're looking for bond ETF, you'll just select bond right there. If you're looking for real estate ETFs, you'll select real estate right there. If you're looking for commodity ETF, the same. So that's based on asset class. If you're looking in terms of attributes, is it an active, is it a passive, is it either one of those, you know? Is it a smart beta or a high currency hedged or leveraged? By leveraged, they mean, you know, do they use do they multiply performance? So 1x, 1.5, 2x, 3.3x, 4x, and the likes. That's a story of another day. It's a long issue. Under the screen also, you can choose how much you want in terms of dividends. So let's say you want a dividend yield of like around 10%, and then you want expense ratio of like, you know, under 3%, and this will filter out a lot of those ETFs and just leave you with the ones that you want. So let's say we want a performance of 3.5 to 10%. If you keep filtering, it will reduce, just like FinViz. This is like FinViz for ETFs. So if you keep filtering, it will keep reducing the number, and before you know it, you will only have a couple of them, and then you can pick now from the best performing. Like here, this is a Energy Select Sector SPDR fund. Year to date has done 62%. Seems like that's one of the best performing at 62%. There's a 31% right here. So you go around and look for the maybe best performing currently, or you look for best performing, in 2 years, in 5 years, in 10 years, and you can see, like, you can arrange in terms of best performing and pick which one you'd be interested to research more into. Like, let's say we want to look into this one. You click on it, and then it will open up that ETF. And you can see this. The issuer here is BlackRock iShares. And then they have the dividend evaluation. You can see what that's all about. They're doing 43 cents in terms of dividends, 3.5 annual dividend yield. You can go into performance, you can go into technicals. We've done this already, so I don't want to bore you with that, all those details. So the site here is etfdatabase.com, etfdb.com. You go to this website to figure out which ETF to invest in, and you can screen. If you go to that tools and screen based on whatever criteria you want. So you want a dividend ETF, you only select dividend criteria. If you want bond ETF, you only select bond as a criteria. If you want real estate, the same. You can filter by performance, filter by holdings, filter by whatever metrics you want. By risk, you want, say, a beta of around 1 and maximum of, let's say this is maximum of let's say 5. If you make that as a criteria, it will give you the results, and you can see these are the ones that meet that criteria. You can change the volatility and all those things.